Hi folks, this is Craig, the options linebacker, and this is the weekend report for Sunday, June 14th. I'm going to start out this weekend's report by looking at a couple of different indices before we get to the S&P 500 and the Russell 2000. First of all is the NASDAQ, and you can see that the NASDAQ has come off of the bottom here with a 49% rally and has actually just hit the 38.2% retracement of the entire bear market. This is a very significant fib retracement, being 38.2, 50%, or as far as 61.8. So this is the first major fib that this is finally tackled. Now, I don't think it's going to be able to make additional gains on here without at least some backing and filling, if not an outright retracement to build a higher low. Now, if we look on the right at the Dow Jones chart, it is just now struggling to escape the 200-day moving average, whereas the NASDAQ is well above that 200-day moving average. And you can see that the Dow chart is still well below that 38.2% retracement, which is around the 9,400 area. The other big difference between these two charts is that the NASDAQ has actually had the 50-day moving average cross above the 200-day moving average, which is a long-term buy signal. The last time that we saw this cross was in December of 2007 when it crossed to the downside. The Dow Jones, as of yet, still has yet to cross. Now, this is very typical price action at the bottom of at least a bear market rally or the bottom of a potential new bull market, is that we'll see stocks such as the NASDAQ and the small caps such as the Russell 2000 lead the market to the upside because of the fact of all those high beta stocks that they contain versus these blue chips, the slow, stodgy ones that are contained within the Dow 30. So now let's step back a minute and take a look at the S&P 500. The reason that I like the S&P 500 is because it really represents the entire U.S. stock market better than any other index right now that we follow. So looking at the S&P 500 on a monthly basis, you can see that the last bear market ended in 2003. We had a very strong bull market for a number of years after that. And here's the current bear market, which is about 18, 19, 20 months old currently. And this gives us some perspective over the rally that we've recently seen over the last few months. The price has actually made a lower low, so what we'd expect at this point is the price maybe inches up a little bit further, and at some point will create a lower high, which is the definition of a downtrend. So lower lows, lower highs, downtrend. Right now the monthly chart doesn't look very promising of continued recovery. But again, we'll just take that one day at a time, 1 week at a time, 1 month at a time. But right now, this monthly chart helps keep things in perspective. As we move over to the weekly chart, things will look a little better there. We've had some strong weeks that we put in place, but look at this overhead resistance from this former descending channel that was broken through at the beginning of October and is just now coming to retest that trend line from underneath. Again, that may be difficult for the chart to get above that, and you can see how also the S&P is still well below its 38.2% retracement. So the NASDAQ and the Russell can't do this all by itself, leading to the upside. At some point it needs some bigger caps to join in the participation as well, and things are starting to slow down a little bit. Now the thing that's got me concerned here is the VIX. Now if you look at the charts, the price charts themselves, obviously the trends are up for the last 3 months and the trend is your friend, etc., etc. But there are some leading signals that we're seeing here with the VIX, the volatility index, and we've been in this descending channel now for several months, and at some time these descending channels will break to the upside. The other thing that we're seeing here is the VIX ratio right now is about 0.63. That's the lowest value that I've seen ever in recent memory. And what the VIX ratio is the current value of the VIX divided by that of the 200-day moving average. So this rubber band has been stretched to the downside, and at some point it will return to the mean or revert to the mean. The VIX is a mean reversion engine. So right now the mean is the 200-day moving average, which it typically will hug as the VIX goes through time. So all this is saying is that at some point in the near future, the charts are probably going to have a bad day. Now this may be nothing more than just a weekly retracement bringing it back, backing and filling, and creating that higher low that I've been talking about on the weekly chart. Now looking at the daily chart of the S&P 500 briefly, the price is still in this little bull flag consolidation pattern, which looks like it's going to eventually break above 950, although here's that trend line again. The fib line is up here around 1010, 1015 for the 38.2% fib retracement on the weekly chart. So there's some definite obstacles overhead. If it is able to break out above this, I don't think the gains are going to sustain themselves. Again, look how close that is to a 50 and 200-day moving average cross. Very close to a long-term buy signal. Now let's talk about position management on the Iron Condor. We've already taken off our 102 strikes on the spiders overhead for a nice profit. And we're retaining these 78 strike put spreads down here, as well as the calendar spread. The calendar spread is no longer needed at this point. I'm going to take it off early next week. Now looking forward to July, we have our 104s up here. We have an 82 short strike down here. Everything still looks really good. We're right on the sweet spot of the Iron Condor. You always want to have more distance to the downside than to the upside whenever possible. For more hints and rules as how we actually got into these positions and how we manage these positions, please take a look at our Iron Condor newsletter. There's a free trial of 5 days before you're billed for the subscription. So until next week, take care folks. Good trading.